Karen, specifically what social inequities and where do you see them beginning to affect markets?
Well, ultimately, policymakers really intend through whatever they're doing to raise prosperity over time. And through most of modern history, standard measures like GDP growth and unemployment were quite good proxies for what was happening with the prosperity of the population over time. So it's what policymakers paid attention to. And in the decade or so coming out of the financial crisis, we started seeing this very significant divergence where we had a huge expansion that did very well in terms of GDP growth and unemployment rate, but actually came along with rising inequality, deteriorating health measures, safety measures, educational attainment, infrastructure, housing, almost any quality of life measure you could come up with. And now, of course, COVID came upon us and has brought upon us not only the worst downturn in many decades, but also a downturn that actually hit the vulnerable the most. So job losses are greater for minorities. Women are more impacted by the need to take care of children who can't go to school in person. Lower income households have a bigger impact from the fact that schooling is interrupted to some degree, less likely to be able to work from home, worse health to start. And then we have this policy landscape that has changed significantly because of COVID that can actually take account of all these social inequities in setting policy. Most important is that it used to be monetary policy was the most important tool, and now both fiscal and monetary policy together are the most important tool. And fiscal policy is, having the most impact it had at any time since the New Deal in World War II. And fiscal policy is really inherently distributional. It has the mandate to look at social issues and address them directly as part of what it does. Monetary policy less so, but even in the context of this changing policy landscape, the Fed is able to say, look, there's such weak cyclical impact on inflation. We haven't seen low unemployment translate to price gains in so many years. So why don't we think about our maximum employment mandate as they're saying broad-based and inclusive? They're saying we want to look at how various communities are experiencing the labor market. In other words, there's much less need to preemptively tighten. And there's much more of an interest in saying, maybe if we don't preemptively tighten, we can actually benefit weaker groups.
So we definitely have the Federal Reserve talking more about targeted, programs and so on, although there is a limit to what they can do, they say, about minorities and, difficult conditions for some parts of the economy. You say that they could do things like the introduction of reporting requirements. On the fiscal side, though, Karen, do you imagine a different president or a changeover in the Senate or something like that would have any impact here, or is it effectively sort of on the path to where you say we're going anyway?
Well, we are pretty vigilant that any president is going to come into an environment with a very large fiscal cliff. In other words, there was this very large stimulus effect where so far actually social distribution issues were addressed very directly by the package that's been employed so far. So stimulus checks went more to lowest income households, the unemployment, all the PPP. We really feel that so far, fiscal policy has been very effective.